today. Okay, audio's good. Audio's good. All right, perfect. So we had a little bit of an issue before, and now we're back. Had sharing issue, then we had audio issue. So first of all, what we're going to do is we're going to go over some revisions, right? Revisions are very important, and the most important revision that we're going to do is going to be formation of support. Then the opposite is going to be formation of resistance, right? Support, resistance. Then we're going to go over identifying an uptrend, downtrend, and when to look for supports, when to look for resistances. That's it. And then we're going to move into impulse entries, and then we're going to start off with our risk management section. So first, we're going to go over some revisions, right? And revisions are going to be basically support formation, right? When are supports formed, or when you should be looking for supports? You should only be looking for supports in an uptrend. Now, whenever you're looking for supports in an uptrend, you have to identify how do you define an uptrend. So the basic definition of an uptrend is when price makes higher highs and higher lows. That's it. That's how you're defining an uptrend. Now, how do you visually look at an uptrend, which is very simple? Now, visually, whenever you're looking at like a 4-hour candle or like a daily candle, what you're looking at is, let's say you're looking at a 4-hour candle and you're identifying this candle as a candle that maybe, you're anticipating it to continue pushing down, or you're anticipating the next 4-hour candle to continue pushing down. So in that instance, let's say this is a higher time frame. So at that instance, you're looking at the lower time frame, which is going to be your 1-hour time frame, your 30-minute time frame, and maybe your 15-minute time frame. Not all the time you're looking at them, but like you're looking at these smaller time frames for confirmation. So let's say you're looking at has the iPad turned dim? Like it dimmed out a little bit? No, right? No, okay, awesome. So whenever you're looking at a higher time frame and you're trying to see where price is going to go, let's say if you're looking at like a bearish momentum, you're looking at resistances formed on your lower time frames. That's all what you're looking at. And a resistance is going to be formed if, let's say, you're going to have a bullish candle, and right after a bullish candle, you're going to be met with a bearish candle. That is your resistance form. And this is valid on the 1-hour time frame. It's valid on a 30-minute time frame. I'm not going to say it's going to be valid on the 15-minute, because 15-minute is a weak confirmation time frame. Whenever you have a weak confirmation time frame, this means that there's a less probability that price is going to continue pushing in that intended direction. So whenever you're looking for, let's say, a resistance to form, you're looking at a downtrend, because in a downtrend, price is going to come down, create a low, come up, create resistance, which is going to be identified with a bearish candle closing after a bullish candle, and then you're anticipating price to continue pushing down. That's all what you're looking at, right? There's no complication. And and then there's another thing. If like you have clean range to the left hand side, or if you have consolidation and whatnot, but you're only looking at resistances formed in times of high volume. Whenever you have high volume, that's the time when you're looking at resistances form. In the opposite direction, can it be explained on live charts? Yeah, so we're going to go over a simulation as well in the end. So in the opposite direction, if you're looking at candles that are moving up, let's say you're looking at a 4-hour time frame or a daily time frame, and you're looking at a candle to move bullish, you're looking at supports to form. So a lot of times what guys do is that they're going to look at a chart and they're going to look at price consolidating in the middle, and then automatically what they're going to see is they're going to see a bearish candle, and then they're going to see a bullish candle, and then they're going to say, okay, you know what? We got a support form in a range. I'm going to take a buy. You can't take a buy. This is not going to be your ideal buying scenario, because we are in a range. So you're always looking at buys whenever we're creating a support and we're trying to move up. Let's say you're looking at a 4 hour and you're identifying the next 4 hour candle to continue to push up. We have a full recording on this as well on a database. You're looking at supports to form on your lower time frames. This is going to be your ideal support form. That's it. This is your ideal support form. Because whenever you have a support form on, let's say, a 30-minute time frame, or you're looking at a 1 hour time frame, or even sometimes, you're looking at a 4 hour time frame. If you're someone who's trading the high time frame, you're looking at a support to form in this instance, and then you're identifying that, okay, maybe now there's a higher probability for the next candle to continue pushing up. And it's a whole different thing whether, a support is formed by, let's say, a candle that's like this. If you have a candle formed like this and you get a support formed, then you got to ask yourself, is this a strong support? I don't think so. I don't think this is a strong support because this bullish candle is not a healthy candle, right? A support is going to be formed if the bullish candle is a healthy candle. So I would say maybe the size of this bullish candle, let's say the size of bullish candle should be the same. I would say the same as the bearish candle right here. Even if it's the same, if it's, let's say, a little bit more than the half of the bearish candle, I would still say that's a support form, which I have noticed because let's say if this bearish candle is this big right over here, right, and the bullish candle is maybe this small. This is a very weak support, whether it's on the 1 hour time frame, whether it's on a 30-minute time frame, or it's on a 15-minute time frame. It's very, very weak. If let's say the bullish candle is this big, this is a healthier support because the bullish candle is now almost half the size of the bearish candle, or even sometimes you can say the bullish candle is, bigger than the half the size of the bearish candle. This is still a strong support. So now the question comes, how do you how to define the strength, strength, strength of support and resistance? How to define the strength of support and the resistance? It's very simple. The size of the candle that's confirming the zone. Size of the candle that is confirming not the zone, but the support or resistance. That's how you're going to identify the strength of support resistance, right? It's the size of the candle. Because if you're looking at a support to form right over here, you're looking at the size of the candle that's telling you that the support is formed. If the size of the candle is small, let's say like this, it's a weak support. If the size of the candle is big, like this, it's still a weak support. But if the size of the candle is maybe almost half the size of the previous candle, then it's a valid support. I'd say it's a valid support. If the size of the candle is more than the half of the previous candle, it's still a valid support. But this only needs to happen when you have volume in the market. That's the only occasion this is going to happen. And when do you have volume in the market? You have volume in the market when you have, pre-London, London Open, pre-New York, New York Open. So whenever I see a support form, a bullish candle forming after a bearish candle, or whenever I see a resistance form, whenever I see a bearish candle forming after a bullish candle, I automatically tell myself that, okay, if this is pre-New York and we have resistance forming, then there's a high probability that price can continue to push down. All right, let me just do one thing over here. Yeah, then I say that there's a high probability that price can continue to push down. What's this over here? Does this make sense? 4-hour candle is bearish. Okay, let's do this over here. 4-hour candle is bearish. Okay. 4 hour candle is bearish, 1 hour candle are bullish and created support. Okay, 1 hour candle is bullish. This means that the 1 hour candle was bearish and then we created support. Okay, create support. As long as the 30-minute candle time frame remains bullish, I can ride the move up and trail stock below the 30-minute. Yes, yes, you can. Yes, you can. But then again, the 4 hour candles, they need to be coming down to eventually start to move up. That's what you want to see. Because if on the 4 hour candle, we are just going bearish, then it doesn't make sense for you to take a buy. Because if we're going bearish on the 4 hour candle, then maybe the 1 hour candles are continuing to push up to create resistance to overall follow the 4 hour downtrend. Maybe that's what's happening, right? If the 4 hour candles are bearish, then you're looking at resistances to form on the smaller time frames for price to continue pushing down, or even on the daily time frame if you're moving down. So you would wait for a 4 hour candle to close bullish. Yes, I would wait for the 4 hour candle to close bullish, or I would maybe wait for a 4 hour candle to close with an exhaustion right here. Because now the size of the candle is, let's say the size of the candle is 30 pips, and the size of the wick, if it becomes like, 70 pips, then we know this is a rejection. So if this is a rejection, then that means on the smaller time frames, like your 1 hour or 30-minute, we may be creating support for price to continue pushing up. And that may create the 4 hour candle to continue pushing up. Right? So it depends how the 4 hour candle is also closing, which is why, if you remember, the things we went over on day one was where's that time frame thing? Which is why you remember we went on time frames. This is morning Asian. Yeah, right here. Which is why you remember we went on time frames, right? And the reason why this time frame was very, very important was because that the first 4 hour is the Asian Open, the next 4 hour is consolidation, and then the third one you have pre-London, London Open, right? So that's why we went over this so that you understand that maybe like now when you're looking at the 4 hour candles to close or open, you can kind of like estimate where you think the lower time frames can go. Are we comparing the bodies or the entire candle? We're comparing the entire candle. Guys, when I say candle, a candle is, from, okay. So you're talking about this one right here, right? In this scenario, yeah. In this scenario, we're looking at the candle bodies, not the whole candle. If the 4 hour is bearish, then the trend is bearish, so shouldn't be looking for buys. Should wait for resistance to form. Yes, that's correct. You should wait for resistance to form. Right? So support formation, simple resistance formation, simple. As we move into our what they call simulations, there's going to be a lot more examples over there as well. So I want to move. So any questions so far based on day one, day two, because then we're going to move into risk management. What happens if the candle forms support, closes with no wick on the top? You tell me, William. What happens? We went over this. 50, 60? I don't know. I haven't calculated that. Yeah. William, you knew the answer. You still asked the question. What's happening? All right. We good? So we're going to move into risk management. Should ask, am I allowed to move into risk management? All right. Risk management. This has been, I think, this has been one of the main pillars of me losing less. Me losing as less money as possible. When we have bearish 4 hour, we can look for resistance and sell as a wick fill. Yes, that is correct. That is absolutely correct. Okay, I smell coffee, but I don't have coffee. Okay, risk management. There are two types of risk management that I use all the time. The first type is we have static risk, and then we have dynamic risk. I don't use dynamic risk a lot. I use static risk a lot. And the reason why is because so I've basically, experimented with both. So when I started to experiment with dynamic risk, what would happen was that I would take a position and price would go in my favor, and then let's say, okay, so before we go into that, let us just talk about what dynamic and static risk is. So when we're talking about static risk is when you are risking your entire risk. Let's say that you're coming on to the day and you're going to say that, you know what I'm going to do? I'm only going to risk 2% per trade, right? So your every trade is going to be a 2% trade. So whenever you're using a 2% trade, it's really easy to manage risk when you're using 2% trade. The next one is when you're using a dynamic risk, this means you are, I'd say like maybe you're breaking your risk in pieces, right? Let's say you have let's say you say that you're going to use a 2% risk, but essentially what you're doing is that, okay, I'm going to use 2% risk, but I'm not going to deploy that 2% all at once. But what I'm going to do is I'm going to deploy maybe 1% on one position and 1% on the other position. Or what you may say is that, okay, I'm going to risk 2%, but instead of doing 1%, I want to do zero point 0.5, zero point 0.5, zero point 0.5, and 0.5, right? So this is what dynamic risk is, that you chop up your risk in different portions and then you deploy them onto your trades, right? Instead of using just full 2%. Because if you're not mature enough to manage risk, which means if you're not mature enough to identify that, okay, now my trade is going in drawdown and I need to cut 50%. If you cannot do that, if you don't have the power to do that, I would say go with dynamic risk, right? Because it takes a lot to cut your risk. And I'll tell you a really good story about that too. So I had to learn this the hard way. So let's say, for example, you have price coming up towards resistance, right? Price came up to a resistance and you're looking at the 4 hour time frame. Well, I'm looking at the 4 hour time frame and we're coming up to resistance. And I tell myself, okay, Raja, this looks like a really good sell because we are coming up towards a resistance. And if this is a 4 hour time frame, and if we're coming up to resistance, this means that there's a very high probability that price can reject and continue to push down. So I take a sell. I take a sell, and my stop loss is right up over here. I take a sell. Price moves up and breaks above this resistance, right? We break above the resistance, and I'm like, oh shit, okay, my stop loss is about to get hit. So what I'm going to do is I'm going to extend my stop loss. So when I extend my stop loss, now instead of losing, let's say $100, I'm in a drawdown of $100, right? I'm in a drawdown. And I'm like, okay, you know what? This is going to continue moving down because the 4 hour time frame, we're at a resistance. But when I look at the daily time frame now, the daily is also at a resistance. So it has to go down. I'm like, perfect. So I wait. I wait. Instead of cutting my loss, I wait a little bit. I wait and price moves up. And now my drawdown becomes negative 200. Has that happened to you? This is exactly how I used to trade. Well, yeah, exactly, right? Now my drawdown becomes 200. And now I'm thinking, oh shit, okay, I'm at 200. And now I'm praying. Okay, you know what? We're at resistance. We have to go down. Oh God, my account is like, $1,000 account. Let's just come down. Let's move to break even, and then I'm going to be done. And then after a while, I look at the charts and we have printed a bearish candle. And once we print this bearish candle, I'm like, perfect. From negative 200, I'm at negative 100. So now we're going to continue to push down. And we continue to push down. And now I get a break even. And I'm like, okay, you know what? We're at break even now. And then from this point onwards, it's going to come back in profits. And then I'm going to close the trade. Perfect. That's exactly what I'm going to do. And after a little while, I look at the chart and I'm back at negative, let's say negative, 120 drawdown. And I'm like, shit, man, I thought we are going to go back in profits. And at this point, it's been like 6 hours, 7 hours, and I'm in the trade and I'm like, oh God, please, please, let's just go back to break even. And I promise I'm never going to remove my stop. But also at the same time, I'm not mentally mature to see what's going on and to cut my loss short. And I'll wait, and price goes back into, negative 200 drawdown. And I'm like, oh my God, what the fuck is going on? And I'm like, okay, you know what? I'm just going to go to work or I'm going to go to bed and I'm going to wake up and we're going to have price that goes down. So I go to bed. And when I wake up, my account is either in a negative 700 drawdown or my account is blown and I'm done. Right? This used to happen to me all the time. And then I realized when I start to look at my mistakes, I used to realize that, okay, wait a minute. We moved up. We basically, okay, let me get a better color over here. So let's get this blue here, right? So when I realized was that, okay, we broke above this resistance. We created another resistance right here, which means we created a higher high. We came down to create support. And when we created support, maybe this was my signal to maybe close the trade because I didn't know better back then. So when we created support, we had to move up. So when I start to look at all the mistakes, I start to look at all the big losses I see, I'm like, okay, how could I have cut down my loss in the beginning when price was moving in that way? What could I have done that would tell me, okay, you know what? Maybe this is the point where I need to cut my loss short. And this used to happen all the time. So then I'm like, okay, you know what? Let's just look at it in a logical perspective. And the only way to look at it in a logical perspective was to identify what were those simple ways how I could have really lowered down my loss. So let's say, for example, you are looking at, at a potential support, right? Price is at support, and this is a 30-minute time frame, right? If this is a 30-minute time frame, what would the 15-minute time frame look like? This is a bearish candle. Maybe the 15-minute time frame would look something like this, right? One 30-minute candle equals two 15-minute candles. Maybe this one is also coming down right here. Make sense? So when you're saying that, okay, I have a support form in an uptrend, and I'm going to deploy 2% risk on this trade. So your 2% risk on this trade is going to go right over here. Your stop losses go below the previous candle. Your stop is always going to go below the previous bullish candle when you're taking a buy. All the time. Below the previous bullish candle. Because if you anticipate price to moving up, if you anticipate price to moving bullish, the candles have to make higher highs and higher lows, right? So let's say you have a bullish candle forming right here. The next candle has to make a higher high and a higher low. And if you're looking at the next candle has also needs to make a higher high and a higher low, which means it needs to respect the low of the previous candle, which needs to respect the low of the previous candle, which also means we have to continue to make higher highs and higher highs over here, and then you got higher lows, and then you got more higher lows at this point. It needs to do that. But the moment this new candle breaks the low of the previous low, your uptrend is invalidated, right? Which means if you have a buy position open right here, and if the new candle comes down and breaks the low of the previous candle, that's where your stop is going to go. And that's where you're going to say, okay, you know what? my stop loss is going to go right there. And when price comes down to my stop loss, I'm done. That's it. I'm out the trade and I lost 2%. That's where your stop loss is going to go all the time. This is static risk, where you're not dividing your risk. You're just using one simple risk and you're deploying that on your buy position. That's how you're taking a trade for a buy. Your stop loss goes below the previous candle, right? So let's write this down over here as well. Whenever, so your stops always go below the previous candle in an uptrend. That's it. In an uptrend, your stop loss is going to go always below the previous candle. Is it most of the time below the previous 30-minute candle? Yes, the 30-minute candle. Mostly the 30-minute candle. But there are also some exceptions to this as well. Now, the next question would be how big the stop loss should be. How about lower lot stops? Yeah, so I would say maybe when you're looking at the 30-minute candle, the stops, it should be maybe I'd say like 15 to 20 pip max based on my comfort level. So my stops are always 15 to 20 pips below the 30-minute candle, right? If the 30-minute candle is a big one, let's say for example, you had a bearish candle right here and you had a 30-minute candle moving up like this, and this 30-minute candle is, let's say, 35 to 40 pips, and you're looking at the 30-minute, you're like, okay, I want to take a buy over here. Then your stop loss is not going to be right down over here because this stop loss is going to be way too big. Maybe this is a 30 pip stop. And I'm not willing to take that trade because this is a 30 pip stop, which means then I need price to move up considerably, right? So what I may do in this scenario is that I may look at, let's say, so you got the 15-minute candles over here, whatever, going down, and then you have a 15-minute candle going up, and then you have another one moving up. I may look at the 15-minute and I may place my stop below the previous 15-minute candle instead of the 30-minute because the stop is going to be too big. So whenever your stop is going to be too big, always look at the one time frame smaller and place stops based on that time frame. Now, don't look at the 15-minute and 5. Only 30-minute, only if the 30-minute stop loss is big, only then look at the 15-minute candle. Gold stopped me today because my stop loss is below the last two 15-minute candles, but then went in my direction. Yeah, exactly. Right? Only the 15-minute candle. If the 30-minute stop loss is way too big, or if 30-minute stop loss is more than your comfort level. Next thing is, let's say you are using 2% risk, right? So let's do this. Actually, I wanted to bring that example down, but since this is a virtual whiteboard, we can do this here again. We have a 30-minute candle and we are creating support, which means on the 15-minute, we have something like this, and we are creating a support area on the 15-minute. Right. So if you're taking a buy at this point on the 30-minute time frame, and if your stop loss is below the current 30-minute candle, let's say this is your stop loss. Now this means you're taking a buy on the 15-minute candle and you're anticipating price to continue making higher highs and higher lows and then continue to push up. That's what you're doing. But let's say, for example, the 30-minute candle starts to push down. And if, let's say, on the 15-minute, that becomes a bearish candle, what are you going to do at this point? If this 15-minute candle breaks the low of the previous 15-minute candle, what's your game plan at that point? Close 50%. Let me just change the battery here of the camera, and then let's continue on. All right. There we go. Yeah, right. So whenever the 15-minute candle breaks the low of the previous candle, I'm closing 50%. So whenever a low is broken in an uptrend, mind you, it's only an uptrend, I close 50% all the time. Whenever a low is broken, not the body, the wick. We're breaking below the whole candle right here. You see this? This is the bottom of the wick. If we're breaking and closing below this area, I'm closing 50%. So when to close 50%, right? This is scenario number one. This is the same for uptrends here as well. If you're looking at the 15-minute time frame and if you're looking at a 15-minute time frame and you're saying that price should continue to move, no, sorry, for downtrends as well, continue to move down, we're moving down, and if the next candle breaks and closes above the previous candle, 50% close. It's the same as a uptrend and same as downtrend. So if we're closing and breaking below the previous candle, I'm closing 50%, right? This is a little bit conservative, but if you're being more tight on risk management, what I may also do is, right? So the second scenario, your second scenario becomes, let's say you have a bearish candle moving down and then you have another bearish candle moving down. Are you guys ready? For the second scenario, let's say we're creating a support, and now we have a bullish candle, and then we have another bullish candle. If the next bearish candle, it starts to break the low, right? So if it starts to break the low, I'm still gonna close 50%. If it starts to break the low, I'm still gonna close 50%. It hasn't broken and closed, but it's starting to break the low. Because if it does start to break the low, then it may look like this, right? I'm still going to close 50%. I'm not going to let the whole thing open because as we're starting to break the low, this means that on the 30-minute, what it means is that maybe on the 30-minute, we may start to form a candle that may close bearish on the 30-minute, or it may start to move down here on the 30-minute. Because if one 15-minute candle closes bearish, that means the next one, yeah. So if one 15-minute candle closes bearish, that means the next one has a higher probability to probably continue pushing down. And I don't want nothing to do with that probability. Are you saying the first example is for when the candle has closed already? Yes, when the candle has already closed. The second example is that when the candle is still open and it's breaking the low of the previous candle. That's the second example. When it's breaking the low of the previous candle, I'm still closing 50%. Make sense? This is only because you're being very, very careful in leaving risk run. So in static risk, you're getting as soon as you see a candle close in the opposite direction to you, you're closing 50% in the beginning, right? Because you're making sure that you don't lose more. You're making sure you lose less. That's how you stay in the game. To lose less, you got to be a gazelle. You got to be a rabbit. Whenever a rabbit sees some problem, or whenever a gazelle sees some problem in the forest or in the jungle or in the vast savannas of Africa, it sees a problem, the gazelle just runs. It takes off. It doesn't stick around. So whenever you see a candle closing below, just close everything. If we're in profit 15 to 20 pips, yeah, we're going to get to that. Right? So now, the third scenario. The third scenario is, can you guys guess what's the third scenario? By the way, it's opposite for when you're trying to sell, you know. The third scenario is when a candle closes bearish without breaking the low, right? Bearish close without breaking whatever with without breaking the low. Yeah, my handwriting. Without breaking the low, I'm still closing 50% because the candle has closed against you. Whenever we take a trade when at least one candle closes in our favor, then we look for a potential trade. But if a candle is not closing in our favor and we're still in the trade, that's when you close 50%. So can you guys still hear me? My audio is good? No answer? That means audio is good. Okay, good. Wouldn't the stop loss hit at that point if it breaks the 15-minute wick? No, because your stop loss, right? So let me point that out here again. Your stop loss is based off of the 30-minute time frame because you're taking a buy right over here. So your stop loss is below the 30-minute time frame right here. So even if the 15-minute candle does this, or if it does this, your initial stop loss right here, it's still protected. Right? So you closed 50%, 50%, you close 50%. So even if the next candle starts to, break and continue to push down, you're not losing your full 2%. Remember that. You're not losing your full 2%. You're losing less than 2%. So the idea here is to lose less than what you've planned on losing in the beginning. If we enter with 1 hour time frame, we manage based on 30-minute, yes, that's correct. In the scenario when we use the 15-minute for stop loss as the 30-minute candle is too big, okay. Then you get stopped out, right? And after that, we will move into how to give your trader a second chance, but not now. Close bearish without breaking low, opportunity to close trade 2. It's not an opportunity to close the trade because what can happen is, like, let's say when a candle closes bearish like this means now we got to see what does this mean on the 30-minute. So this means on the 30-minute, we may have closed, let's say this is a bullish candle. Let's say on the 30-minute, we may be something like this. And since there are two 15-minute candles and one 30-minute candle, the next 15-minute candle, it could continue to push up. And on the 30-minute, it may look like, the candle came down to do liquidity, grab liquidity, and then continue to pushing up. Make sense? Sound is getting choppy. How about now? Even if the candle body is weak, are we closing 50%? It depends. It depends on scenario, it depends on 30-minute, depends on 1 hour time frame. So it depends on all those variables to kind of see whether if we're closing a weak bullish candle, can we still move up? Or depending on how much you've seen that a candle is going to close weak bearish and the next one continues to move up or continues to move down. That all depends on how much you've seen that before. Would you also use the 15-minute risk management if your entry and stop loss based on 30-minute? Yes, I still do that. What's the difference between 1 and 3? So 1 is when a candle has broken and closed below the low. You're closing 50%. 3 is when candle has closed against you and you're still closing 50%. And reforming support on gold, is there any harm in looking at how much the DXY or CHF? No. So we close 50%? No. I close 50%, and that's what worked for me. Maybe that's going to work for you too. So if you close 50% when candle close bearish, what do we do if next candle also starts to break the low? If the next candle also starts to break the low, you tell me what are you going to do at that point? Harmanjeet, Mr. Muscleman, close it all. Yeah, right? Yeah. Close another 50%. You're going to close another 50%. So you're going to lose even less money at that point. Speaking about muscles, I forgot I had my egg whites today, so I brought them with me. All right. If the bearish candle is approaching previous resistance, we should close 50% or full. If the bearish candle is approaching previous resistance or support. Support, you mean, right? Yeah, then I close full. Because here's the thing, 90% of the time, right? 90% of the time, you're going to know that price will hit your stop loss. 90% of the time, you're going to know price is going to hit your stop loss. All the time. Guarantee. And a lot of times we lose trades or we lose more than we expected to lose because we see price is moving. We see price is moving towards our stop loss. And I'm like, and you're like, oh, should I hold it or should I close it? I know it's going to hit my stop loss, but I'm going to watch it hit my stop loss. Why are you going to watch it hit your stop loss? Just close the whole thing. When you know it's going to hit your stop loss, just close the entire position. That way you're going to save something. Holding in negative, it's going to hurt you the most. Whenever you hold the trade in negative, it's going to hurt you the most. Right? So static risk. Static risk is based on, you're closing your positions, you're cutting half, because whenever you're taking the trade, or whenever I'm taking the trade, I'm always looking to see how can I lose less all the time. Even whenever price goes in profits, I'm always looking to see how can I lose less. Because if I can always look at how can I lose less, I don't care about the money. I don't care where price goes. I don't care how much it moves. I don't care how much profit it does. I only care how can I lose less and what can I do and how can I mitigate risk when it comes back to my entry point. We're also going to talk about how to what to do when price goes in profit. Actually, let's talk about that over here. So one more important rule I use is whenever, this is just a point to make basically. Whenever price goes in profits, I would say maybe, 5 to 8 pips. And comes back to break even, I close 50%. I just close the 50%. Because the thing is, whenever you were up in profits, let's say this is profits, this is your break even, and then this is your loss. So whenever you're up in profits, right, and you're making positive money, positive, and when price comes back towards break even, I'm never, ever letting price go back and draw down with that full position. Never. Because it's going to be a sin if you were in profits and price goes back into loss and you close in a, and you close in a drawdown. I think it's a sin if you let that happen. I never let that happen. Whenever I'm in profits and price goes back to my entry point, I close 50%, no matter what happens. I close 50%. I don't care whether price goes back in profits, whether price goes in negative. I don't give a fuck where price goes. I close 50% whenever I'm in profits and price comes back to my break even. I close 50%. I get rid of that, because the worst that can happen is that you were in profits, price came back to your break even, and you said, okay, we should go back up. But instead of going back up, it goes to a loss, and now you've lost whatever 2% or 3% you had to lose. You lose that, but instead you could have lost, let's say, 1% because you closed 50% at break even, and now you let the rest run. And if that hits your stop loss, you still lose 1% instead of 2%. If you were in profits, why don't you close 90% for a small gain? I don't know, because I'm still wanting to get like 10 to 20, 25 pips. If it's coming back to BE, yeah, we don't know if it's going to come back to BE. If it's coming back, we don't know whether it's just reversing. So we don't know. We don't know. Yeah, right? So always like that's my rule. Whenever price goes into 5 to 8 pip profits, and if it comes back to break even, I close 50%. That's my rule. So you still always target 10 pips? Yeah, 10 to 15 pips. Always target 10 to 15 pips. In the start of the week, I target 10 to 15 pips. You know, by like Wednesday or Thursday, I'm more inclined to letting my positions run, which stops at break even. Or I trail my stop losses. Yeah. Can I do this over here? Oh, nice. I can do this. Can I do this? You guys can see, right? Yeah, you guys can see. Perfect. So if I look over here now, can I write on this chart? No, I can't. It's not that fancy. Right? So this is where I took my entry. I took my entry. I want to take my entry, like we're moving into pre-London. I want to take my entry when we were anyway, yeah, you guys can see. When the bullish candle was breaking above the high of the previous bearish candle, that's where I wanted to take my entry. All right. Yeah, so initially I wanted to take my entry right over here, but I wasn't sure whether this candle is gonna like, what this candle is gonna do. But when this candle closed the bullish candle, we had a rejection down at the bottom. We also made a higher low. We're moving into pre-London, London Open. Well, pre-London. No, it's not. I think this was around after Asian Open. Was anticipating volume to continue pushing up. We did go up, and essentially we continued to push up even furthermore. But the stop loss was down over here, and then we moved up towards this area. We closed the bullish candle and let it run. So yeah, we just continued to move up over here. Yeah, this is very cool that I can do that over here on the fly. And support formed there as well. And then we had clean candles to the left and side. So yeah. What was the range on that? The trade you took? The range was from 1914 till like 19, almost like 1915, 80, 1916 for price to continue to push up. So this was like almost like a 20, 20 pip range. This was a 20 pip range. It was pre-London 1 a.m. Eastern time. Yeah, there we go. Pre-London. The previous trade didn't have the candle closing bearish. No, it didn't. Why did you anticipate price to push up? Aren't we in a range? Yes, but we had volume at that time. We had like around pre-London time. So there was volume at that time. So anticipated volume to continue to push price up because you had this candle close a weak bearish candle, which means the momentum to go down was decreasing. And then this candle closed a strong bullish candle. So we were also in pre-London. So if we're closing a strong bullish candle, then you got to ask yourself, what's the probability for the next candle to continue to push up? So even if I look on the 4-hour time frame, the 4-hour was also indicating that we should continue to move up. You can see there was a support formed. Next kind of broke above the high. We closed bullish. We had clean range to left hand side. So that's where you start to ask yourself, that, okay, what's the probability for price to continue? This was pre-New York? No, bro, this was not pre-New York. Pre-New York is now. Yeah, pre-New York is now. This was pre-London. This is pre-London. So this is what I was talking about previously, that when you have the higher time frame, so the 4-hour candle closed with a support formed at the bottom. You can see there was a support formed. And then we're asking that, okay, if we got a support form, so let's do this, right? Yeah, it's pretty cool. So if we got a support form and you got this whole range on the 4-hour, so this range becomes like from 1912 till 1922, 100 pip range, right? So you got a 100 pip range. You got support form on the 1 hour on the 4 hour time frame. So now if you got a support form on the 4 hour time frame in a 100 pip range, what do we want to see on the smaller time frame to kind of like, guesstimate that price can continue to push up? What do you want to see? We want to see a support form. So we got a support form. And then also on the 1 hour time frame didn't really have that of a clean support, but the 30-minute had a clean support formed, and this is also moving into the new 4 hour candle. So made perfect sense. So pretty much when you say volume, you mean as long as you are trading in the session that is open. Right now, no volume in AUD pairs. Yes. Yes, Victor. That's absolutely correct. Absolutely correct. Right? So, and the good exhaustion, that's true. Do you take the trade based on a 30-minute support? Yes. Volume is not an exact science. Yes. But volume, you can anticipate, right? You can anticipate volume to come in during different sessions. Like, let's say if there was no volume in pre-London, well, there was volume in pre-London, then you can see there was no volume around London Open. And then you move into pre-New York, the volume in pre-New York, then at New York Open, there may be no volume. Then at NYC Open, there can be volume, and so on and so forth. Uh, would you say it was risky taking that trade after it broke the resistance since it moved up already? Nope, it didn't. Let's see over here. Oh, I have a MetaTrader over here as well. Yeah. Which one? It was risky taking that trade after it broke the resistance, waiting for the candle to. Oh no, no, not at all. Because we were still, I think we were, I think we were still in this scenario after the support was formed. Oh, let me just make this a little bit smaller. After this support was formed and the candle closed bullish, there was a very, very high probability for price to move up because this was around pre-London. So, and also the 4 hour had also created a support. So this wick down, right? This wick down was the wick down on the 4 hour time frame. We move to the 4 hour time frame. On the 4 hour time frame. If you look at this right here, this was the wick down on the 4 hour time frame. Does SR to be formed on the candle body close or same price? So support resistance, like I'm not gonna say that it needs to be formed on the wicks, but you can maybe say that, okay, this is support form right here. Instead of saying that, oh, this is support form. No, that's not going to be the support form. It's like, around like the body of the wicks, that's where the support is going to be formed. So any questions on what's this? How to identify pre-London will have volume to break resistance? Some pre-London don't have volume. Yeah, some pre-Londons don't have volume. So let's say, for example, right here, if there was no volume and I took a buy on the 30-minute time frame, if there was no volume, then what would have happened is this, that the candle on which I took the trade, this one would have looked at this resistance and maybe it would have closed below that resistance like a bearish candle or whatever. It would have closed like a bearish candle, rejecting that area. And in that sense, I would have said, oh, okay, you know what, there's no trade at that point. Then we would have said, okay, there's no volume here at all. But it was pre-London, there was volume, we moved up. And after we moved up, you can see that price started to consolidate, wick around, and then we moved up for London Open. And then now we're moving into pre-New York. What's the time right now? Yeah, 7:30. We're moving into pre-New York. So there's no volume at this time, right? If this 30-minute candle now, we close bullish, then maybe at New York Open, we could continue to push up. Okay, let me go right over here. Much better, right? If this candle starts to close bullish, then there's a high probability we can continue to push up with NY Open, right? So we're lucky we're here, so we can take a look at the NY Open as well when it happens. Why does the 4 hour candle start 1 hour before intermediate markets? Because we have a different liquidity provider. Definitely need to be action. Yeah, exactly. So any questions regarding static risk? Static risk is very simple. And then, like you're closing 50%. So the main idea is that you're using one single risk, 2%, 1%, whatever you want to use. And as soon as one lower time frame candle closes against you, you're closing 50%. That's all what you're doing. Very simple. And as you do this more and more, it's very natural that you're going to start to incorporate more ideas in your risk management. The more time you lose, the more time you manage risk, you're going to start to look at the risk again, and you're going to start to ask yourself questions that, okay, what can I have done something differently? How could I have lost less? So these things are going to come automatically as you start using risk management more and more. Okay, makes sense? Perfect. So what we're going to do now is I'm going to let this recording buffer. Let's take like a 15-minute break. I'm going to get some coffee, and then we're going to be back with the new Zoom link. I find it hard to differentiate if you're a scalper or a day trader. I am both. Day trader is, there's no such thing as a scalper, and there's no such thing as a day trader. You guys have to forget about that, right? All these terms about day trader, scalper, they were made to sell you a course, right? Oh, I'm going to make you a scalper. I'm going to make you a day trader. There's no such thing like that. A scalper is someone who overtrades and he loses all the time. A day trader is a person who holds massive drawdowns and loses anyway. You're just trying to trade. You're taking 1 or 2 trades a day. When you take one trade and you close 90%, you leave the rest running wherever it may go. And then you build confidence that we're going to talk about tomorrow. Where was the stop loss in pre-London trade? Why did you take the second entry at pre-New York and then closed full? Which one? Which one? This one, the small one you see? That was a test, man. Like, I'm sorry if you're coming late to this. That was a test. And just as we mentioned in the last half hour, the stop loss was below the previous candle. That's what the stop loss was, below the previous candle. Guys, you can't come late to class and then ask questions we discussed like half an hour ago. So anyway, so we're going to let this buffer. The time is 40 over here, 7:40 a.m. Eastern, 40, 50, 55. So we're going to be back at 7:55 a.m. I'm going to get coffee and I'm going to let this recording buffer. And a new Zoom link is going to be sent in the general chat. So we'll see you then. Hopefully this whole thing works again. You know? Yeah, we're going to pray.